In this video talk, we're going to show you how we can program fiduciary returns to match fiduciary obligations for stewardship investors. We do this by constructing a portfolio of going private transactions using the evergreen equity split architecture. We want to show you that this works with real companies at scale and across the entire network of the economy. And so we have built a little mini portfolio here around three large market-leading companies in three different economic ecosystems. One is in branded consumer products, another industrial services, and a third information technology. Procter & Gamble is our consumer brands example. Schlumberger, an oil field services and pipeline company, is our industrial services example, and Microsoft is our technology example. Each of these companies is currently trading in the public markets, and there investors can realize returns only by trading on shifting perceptions of value within a paradigm of buying for resale. We are showing you here a path out of this buy-sell paradigm and into a more programmable cash flow sharing paradigm that will more effectively and efficiently deliver programmed returns to fiduciary portfolios. For each sponsored enterprise, we show you the amount of fiduciary funds being invested. Immediately below that are the splits of cash flows that are flowing into this portfolio from each investment and in total. You will note these numbers represent billions of dollars. This example is very large. The total portfolio is $353.42 billion, and portfolio cash flows start at $42.28 billion and grow to over $67 billion by year 20 in this portfolio. You will see here that we are presenting modeled results for the first 5 years and then selectively at years 10, 15, and 20. That is for the convenience of keeping this presentation compact and viewable. We do stop here at year 20 because this is the limit of our base case. Within this 20-year period of time, we are expecting to exceed our fiduciary returns by fully recovering the corpus of originally invested funds while continuing to fund the associated fiduciary obligations. As these arrows indicate, each of these sponsored enterprises is expected to keep operating beyond 20 years, and the equity splits will continue to pour cash into the portfolio on an ongoing basis. This is why we sometimes call them evergreen equity splits. They are like a gift that keeps on giving. You can actually see here that by year 20 of this base case, all of the invested corpus has been recovered, and the equity splits continue to pour cash into the portfolio. So at this point, all of the cash coming in is available to fund fiduciary obligations because all of the corpus has already been recovered. And so there's actually more cash coming in than this portfolio needs, and a surplus is being created. And this is a primary design principle and competitive advantage for the evergreen equity splits, to generate more cash than is actually needed to sustain corpus plus benefits, and then to keep that surplus cash flow pouring into the portfolio for as long as the sponsored enterprises remain competitive in their respective commercial markets. We show you this as actually matching longevity to longevity. Now, returning up here to the summary, you can see that the equity splits are growing over time in each of these companies. This reflects an organic growth assumption built into the base case. And this is in part how the IRRs are growing to 6% by year 10 and then continuing to grow to 13% by year 20. Please note these IRRs are based only on the equity splits that are being paid out by the sponsored enterprises and flowing into this portfolio. Total cash flows within those enterprises should be higher. How much higher will depend on how well actual results match the base case that's being modeled here. In a properly constructed base case, actual results should always exceed modeled expectations by a comfortable margin. That excess is what goes to the leaders of the enterprise as their reward for doing what it takes to get the corpus plus benefits paid out to their stewardship sponsors according to the agreed program. The next line here shows the total amount of fiduciary funds invested in this particular portfolio. You can see we have kept this amount constant in each year. To keep things simple, we have not compounded for inflation. This isn't an oversight, it's a deliberate choice. For this exercise, we really wanted to avoid the complications that can arise when reinvestment is being modeled to support an inflation assumption. You'll note we also don't reduce this number for investment recovery. In our program, fiduciary obligations are being calculated as a percentage of the corpus originally committed to the portfolio, and not just on funds still at risk in the sponsored enterprises. Here, we have identified 3 line items that make up fiduciary obligations. As we just discussed, the first is for inflation, and we've intentionally omitted that to keep things a little simpler. And this leaves us with the payout of fiduciary benefits, which we have budgeted at 5% of corpus committed to this portfolio, and costs for fiduciary administration, which we have budgeted at 1%. This gives us the sum of $21.21 billion that this portfolio must generate each year in order to sustain its ability to pay its benefits. This, of course, is assuming, as we have, that the corpus remains flat, in that we calculate the payouts as a percentage of that corpus, which is what we've done here. In reality, of course, these numbers would have to be going up for cost of living increases and other such factors. But here, we have brought down the cash splits pouring into the portfolio each year, and we apply a portion to a planned program for recovering invested corpus here, with the remainder, which is here, being available to pay current fiduciary obligations. And this is what we mean by matching fiduciary returns to fiduciary obligations. This line shows that there's actually a surplus each year of cash available over cash required. And this is what we really want to do, is generate this surplus. And let's compare this to the historical experience with public market trading, which the stewardship industry has had dating back only to the 1970s. And there, the longevity is being matched to liquidity in transient ownership, and valuations are fleeting, and paper profits in one accounting period have proven able to evaporate in another. And so what we see there is a recurring pattern of booms that always eventually go bust. This happened most recently and most dramatically in 2008, but it's a constant reality when you're mismatching longevity against liquidity, because net asset values are not a return. There's only an indication of what the return might have been. So the impact of the equity split surpluses is shown here in this final matrix of calculations. Here we bring down for each year the amount of cash programmed for the recovery of corpus, and then the amount of surplus cash left over after fiduciary obligations are being satisfied, to show the amount of fiduciary funds available in each year for new investment. Down here we see how this accumulates over time, so that the size of the portfolio grows as a result of these surpluses, even after the current fiduciary obligations have been paid. But going back up here to this line, we want to emphasize that other than some reinvestment to keep pace with inflation, none of these funds actually has to be reinvested in order to support the continuing payout of corpus and benefits. The original equity splits will just continue to pour cash into the portfolio in the out years, supporting fiduciary obligations to the limit of the base case and beyond. So let's consider the power that this gives the capital steward. If corpus is protected and benefits are funded, then new investments can be pursued based on the impacts they will have. Some new investments will be selected for their positive financial impacts on fiduciary funds. That's good stewardship. Others can be selected as much, if not more, for their positive impacts on society. That also is good stewardship. In this way, you can see why it is that we say that the evergreen equity split is good stewardship.